TGIF traders, we write February 20th of, oh, 20th? Yes, and we are Friday. Welcome to the Flow Show. Ryan will be back with us on Monday. This is Cayman. I'll be your host again for today. Before we move on to the show, just look at what you can still do here. You can still join us for only $1 for 10 days. Then you can also put your name, email address on here to be on our weekly list and to keep you up to date on whatever is going to change when we will be morphing from Forex analytics into trading analytics. It is getting very close now. And let's, without further delay, start the show. First run to, oops, sorry about that. First run to a bit of headlines. I don't know what this, I haven't been looking at any furniture. What's this ad for furniture doing on my screen? But anyway, let's get this show on the way. Um, First of all, geopolitics. There's still every day stuff going on between US and Iran. Yesterday, we had a little pop in risk when Trump said that he had good talks with Iran, but then he added straight away that they should make decisions within the next 10, maximum 15 days, or something bad may happen. And media articles coming out saying as well on the back of it that he may think about surgical limited strikes on Iran to force them to meet the US administration demands for the nuclear deal. We know that it's their red lines are about missiles and nukes and stuff, and but they may move in. But he said not necessarily boots on the ground, or he even said like they won't probably be boots on the ground, but they could go with some surgical strikes just to force the issue a little bit. On the Russia-Ukraine, not a lot. Talks are supposedly restarting next week. Zelensky wasn't really surprised about this week's talks, but yeah, we know the pressure that he's under from the US as well to reach a deal. So every week that goes by, there may be some news to unlock the situation, perhaps, but that will be for next week. Um, and that's about it today on the geopolitical front, luckily or happily. But this US-Iran situation is probably also the reason why we see metals trading higher this morning as it's a bit of a hedge going into the weekend against any potential risk. So coming out of the weekend, we will see a few of those instruments likely on the move again in the one or the other directions. And I'm also thinking, obviously, about oil, which remain pretty well bid. Both oils, the Brent and the WTI, are still well bid. Probably will remain bid into the weekend, and then we will see what happens with them once we get out of the weekend, whether there has been anything um, disastrous or not happening. Usually limited strikes, surgical strikes on specific targets, which are usually geographical targets instead of human, etc. targets. So they are relatively quickly shrugged off by the markets. But in case of oil, depending on what the strikes may hit, if already those strikes happen, oils may be on the move again, especially if some ports also are hit. Central banks, and there's been a bit of U.S. central bankers out. Kashkari was on the wires yesterday, pretty supportive for Wash. He's well qualified to be Fed chair, he said. He also said that he was unsure if the Fed could shrink the balance sheet further without fundamental changes. So that's a first a first point, which I'm sure he already made, but on Walsh's to-do list if he gets the seat, of course. But then he had some interesting comments. First of all, on both mandates, which are prices and full employment, he said that the Fed's is close on both mandates, that the rates are quite close to neutral. But then he added something about the comments that U.S. officials made, and especially Hassett's comments about the Fed staff research were just another step to try to compromise the Fed independence. So the more Fed members we hear, apart from those who are appointed, let's say, via Trump of late, are starting to criticize all those comments. I guess with reason, if you look at historically why and how the Fed was created and what their mandate is. But just worth noting that he quite openly said that he didn't agree with what Hassett was saying. And then we had Fed Dali also saying that they are in a good place right now. More work needed on inflation, but must avoid over tightening or falling behind. That is as much as saying we are data dependent, obviously. And she also added that the labor market doesn't always necessarily provide clarity. So there as well, she's a little bit in the dark as what could happen further down the road on labor. It's obviously a big part, and we've been talking about that so often already of late. It's a big part of what the Fed is monitoring right now. And then we had a bit of a surprise from Myron, who is usually the outspoken dove on the Fed at the FOMC, and he now changed his view a little bit. He said that he sees less 2026 rate cuts than he thought until the end of 2025, on the basis of improved labor market conditions. So thinking that the labor market could fall off a cliff was also the idea why the dollar had been sold before. But Myron changing his view is maybe an interesting one, just in preparation of Mr. Walsh's appointment, right? So that for the Fed. What else do I have on my little list here? I think, oh yeah, sticking with the central bankers, we had a comment out overnight from the RBNZ Bremen. Forward-looking policy is not on a preset course. It's possible to see economic expansion without the inflation getting lifted. So that is somewhere telling us that they may be at the end. Also, we heard from the other member yesterday from the RBNs that they may be at the end of the cutting cycle, but they still are monitoring what's going to happen. Not being on a preset course leaves the door open to both hikes and cuts, obviously. But the interesting part here is that they clearly over the meeting that we had from the RBNZ that shed their dovish wings. Now it's going to be the data that tell whether the Kiwi can recover, and then especially if you look at where it could recover, obviously versus the dollar, but that's not only the Kiwis. Not only in Kiwi we can do that, but especially the looking at the dollar as well. But then especially we're thinking about the cross that we're all watching, and that's the Aussie Kiwi. If New Zealand can um, recover and have a better economic situation through the data, Kiwi could potentially recover a bit. And I'm going to look at the Aussie Kiwi today because we are close to very, very interesting levels. Moving over to Japan, and I'm straight away going to look at what's happened here on the CPI, because it came off it came off further. And if you look at the headline number, the national CPI here, it actually dropped quite a bit in January. There are potentially some base effects also at play, but a lot of subsidies, etc., are also helping to keep this inflation low. So this may put the Bank of Japan in a little bit of a more difficult spot to hike rates, but it's not necessarily a lasting thing here. But yeah, inflation is obviously one of the big pillars that Bank of Japan and UEDA are using to hike rates further, putting them at 1.5 and the core at 2%. If they say that the core is at 2%, that is still around their target, okay? So that is still not closing the door on rate hikes. I would by no means say that the Bank of Japan is done hiking rates. That's not at all the case. They are only at 3.75%. They could easily go a little bit further, and still, I think April is on the cards. And being in Japan, we have to talk about the Prime Minister Takaichi over there. There has been a Yomiuri poll out overnight, and or yesterday the results came out overnight, and the Japanese cabinet approval rate spiked again, 6 points, up to 73%. This is, I think, for Japan, record approval rates. So that means that the Japanese people are really confident in the abilities of Takaichi to get Japan on a roll. So she was out with loads of comments overnight again. A few of them I'm going to run through. She said that they want to hit the higher growth button, multi-year budgets, to put multi-year budgets in place to spur investments. There is a plan for those long-term fund and multi-year budgets to really boost investments. And the thing is, she also said, obviously, and which she already said before, that this is not the time for fiscal tightness, that they want to really spur growth and basically make Japan investable again. There were kind of other lines as well. And I'm back to a bit of geopolitics there. We know that she wants to change the law regarding the defense pact or something. And she also said that the security environment that we're living in right now is the most severe since World War II. China is intensifying coercive actions. North Korea is continuing nuclear and missile development. And then Russia invasion of Ukraine persists. And the Russians have not missed the occasion, obviously, to come out this morning reacting to that, is saying that Japan is actually heightening the tensions instead of them trying to do the opposite. So we are not at the end of geopolitics, and as we heard already from from China, on Takaichi's comments before, Japan may come into the frame now as well. So this is one to follow. But and the main message here, she did say that they do not want to use what is here. They do not want to use those deficit financing bonds. That is for the planned tax cuts, but the rest of all the funding is still a little bit up in the air, of course, because there's plans for multi-trillion yen investments, and she really hammered that through again overnight, saying that they want to break away from years of excessive fiscal austerity and prolonged pattern of underinvestment in the future. And that, I think, tells enough, and that is likely the reason why we are seeing the yen remaining under pressure here, because we have seen that very big investments in countries initially have a watering down of the finances effect, and therefore weigh a bit on the currencies. And then to finish with Lagarde, there's been all kinds of rumors coming out. about her potentially leaving early. But then yesterday she had an interview. I think was it with the Wall Street Journal? Was it with the Wall Street Journal? Let me just yeah, it's with the Wall Street Journal. She had an interview saying that her baseline right now is still to finish her ECB term, and that the World Economic Forum is only one of the many options that she would have once that term is over, or once she decides to leave the ECB boat. Okay, story to follow. What's been going on and what's going to happen for the rest of the day? So we had a bit of data out overnight. We had those Aussie PMIs out, quite a bit setback from the January data, which were very, very good. It's a bit of a setback in February, but just note that we are still in expansionary territory. Okay, Charles. Yes, I forgot to answer you yesterday. Look, I'm looking at a lot of instruments, a lot of media outlets. X is one of my sources, but I also have a Squawk box. We at Forex Analytics we use Live Squawk who update us throughout the day. If you are in our Forex Analytics community, you will know that, and you will see that they really are very actively updating. And then I use one of our sponsors for our NFP competition as well, the Peak Suit. Reuters, Bloomberg are another source, but just know that for Reuters and Bloomberg, especially Bloomberg, it costs an arm and a leg if you're a privateer to have a full Bloomberg access. So I'm rather using them for the reading of articles or updates um, that are not really market moving on the spot. Okay, it's not pixies, it's Pixoot. I'll write it. I'll write it in our chat, Charles. Okay, just look it up, and you will see that they are doing quite a good job as well to put articles and news up. Okay. Right, back to what's been happening. So I was on these Aussie PMI, so it's PMI day, as I already said yesterday, and still in expansionary territory, but giving some back. All right. Then we had the Japanese PMIs out. They were also pretty good in the preliminary PMIs in February. I'd argue that is something that the Bank of Japan and especially also people at and I'm thinking about the finance ministry, Katayama, who is obviously a very active participant in putting all those stimulus packages, et cetera, together, get good PMIs out of Japan. They will be comforted by what is happening economically in Japan. So that is going to be potentially another green light for them to push forward with all the changes and all the impulses they want to give to the Japanese economy, of course. Then we had DB. Stop looking at what's coming on the right here. I have absolutely no say in what kind of ads I'm getting on this page. Um, yeah, I know you're just kidding, but anyway, it's on the chat. It's written black on white, Timmy. I mean, I'm whatever you say may be held against you. Okay. Right. Back to some more serious stuff, okay? Uh, Retail sales out of the UK, better. Public sector net borrowing, better. Here, the net cash requirement, better. We may argue that this really counters everything that's been negative out of the UK this week prior. but we have to know a little bit of what the background and what really is going on here. And thanks to Michael Brown as well. On the retail sales, apparently they are really being pumped up by arts and antique sales in the month of January, which really have been pushing those numbers higher. So those higher core retail sales, those higher retail sales may be a one-off. And the public sector net borrowing negative being a budget surplus is also a lot having to do, and I've been looking at on their website, also having a lot to do with typical January effects, taxes, etc., etc. But has to be noted that it's one of the better months, or if not the best month, for in a very, very long time. So that is that has supported somewhat the sterling, at least prevented, for instance, euro sterling to break above that 87.5. Okay, and then we moved over to what happened in Europe this morning. We had the Stocky CPI, a little bit higher, flat reading. The harmonized CPI here also ticking up just a little bit, but nowhere near levels that Riksbank would say would raise the antennas and telling them to go more hawkish again. So I think that leaves the Riksbank more or less where they are right now. French PMI services, bit mixed. Manufacturing dipping back under 50, unfortunately, but the services ticking up a little bit. But they both remain under the 50 mark, so that's still below expansion for France. Germany, in turn, has turned its head above water. Business activity are ticking up to a 4-month high. Manufacturing is back into expansion for the first time in a very, very long while. And the new business activity in German goods and services, both goods and services, is the best since 2022. Prices also have been rising. So not everything is for the greatest, but because prices are rising and the price hikes are potentially and apparently already been pushed through. So it's not all rosy for the consumer, but on the face of the numbers, Germany turning its head back above water is, of course, even for the pan-European zone, a very good thing. We have seen, by the way, the manufacturing in Eurozone ticking up back above 50 as well. Services a little bit better than the last time, kind of where they are expecting, just a tick a bit lower. But it brings the European PMIs also to levels where it's not overly comfortable, but better, let's say, okay, better. And then finally, we had the UK PMIs out, also printing very, very decent numbers. Good expansion, though, with that caveat that says the job losses are still continuing. Okay, that's for the negative side of things. But the business activity, etc., is definitely still on a very good path, very good expansion here as well. And that actually was the clincher this morning to turn the ship around in sterling. Retail sales, the budget surplus was just stabilizing sterling. This was a bit of the kicker to print a better outlook or a better sterling this morning. Okay, what's next? We do have the Mexican retail sales, but they are dated for December, and then obviously we go into the whole slew of US data coming out. We have the preliminary Q4 GDP prints out. They are expected around quarter on quarter 2.8%. The price index should be coming a little bit down, but those numbers, I'm not sure if those numbers are really, really up to date because I did see on some um, analysts that the Q4 GDP may surprise on a bit on the upside. So we will wait for those data to tell us exactly what's going on. We also will have the PCE obviously coming out, but that should be not too far away from where those expectations are. This is, I think it's, was it 2.9 that, oh, here we go. 2.9 that Powell and I don't know who else was already hinting at. They may be a tenth, maybe even 2 cents away. But usually it comes out not too far from where they told us that they think it should come out. Obviously, here, what we are going to watch first and foremost is that if we stay below 3, if you get a 3 back in front here, maybe we can see a bit of a move on the yields, and then also on the dollar on the back of it. So PCE is probably what we are going to have to watch first and foremost. I would not dismiss the personal income numbers, the spending, etc. The consumer always has an importance. Just note that they are also December data. Okay, so a little bit dated. And then later we will have, as I said, it's PMI day. We'll have the S&P Global PMIs as well. They have been doing quite all right, if I recall correctly, over the past few months. So we will see what the outcome is there. Those are still preliminary numbers, and we will have the Michigan as well on top of it to crown the day. We will also have a few more speakers, I think. Yep, Logan is on the token as well. So there's a lot to go through at the end of phase today, just to see whether the dollar can continue what it's been doing basically since a full week, and that is print small higher highs and small higher lows as well. The pattern has been very clear over the past week and a half. And then to crown it all off, as Fred rightly mentioned, I noted it in big letters on the top of my sheet, is that we have the return of SCOTUS. And I have been looking on their page, and I don't know if anyone really has more information about it, but as it is noted there on their page, it says that it's a conference, non-argument day. Of course, they may announce opinions. Okay, that is what the market is waiting for. But if it's a non-argument day, will they reach a decision? Is really going to be my question, and I don't have the answer to that. Anyway, 10 a.m. New York. New York time. They're opening shop. So from then on, it is going to be a SCOTUS watch again. See if we get anything before the weekend, or if we have to wait for next week, because next week on the 23rd, 24th, and 25th, we have argument days. Okay, so maybe next week is going to be the week where we finally hear some of the rulings that the SCOTUS may have in regards to Trump's tariffs. Okay. That's it for what's on the docket today. So let's move over to what is going on the prices. Interesting here, euro dollar, I mentioned it yesterday, 117.4550, tested again this morning, holding for now. But what we see, this pattern for a week and a half, is still ongoing. Okay, unless we start to get back above 117.75, 117.80, it's still a very, very, very clear pattern. Okay, and I still would argue that the data should show us to get back above 118 figure 5 here. You see that high, that low, that high, that high, before we can say that this pattern is really broken. I think we have to go back to the high that we printed yesterday, and then I think that pattern of lower highs, lower lows in the euro dollar, inversely lower higher lows, higher highs in most of the dollar pairs. That is the data, I think, or SCOTUS maybe this afternoon, that is going to tell us if it is finally going to break or not. We really think that there's been a program, a dollar buyer, ongoing for the past week or so, but we don't know whether those people are done or not. That is going to be shown by data in the market this afternoon. What happens if the data in the US continue to outperform, or there is more stress coming from US Iran, which has been putting a bit under the dollar as well? We could see a break of this 117.40-45, and then I think we would see a move somewhere down into the 117, 116.85 or so. That's also within the possibility. So that's where I'm looking at for the euro dollar right now. Cable was looking, and I'm going. This is the longer end, because on the updates this morning, and I borrowed it from Blake. He was looking at this 200 DMA, which came in right around the 50%. Oh, it comes in, still there, right around the 50% of this, the move from November into end of January, actually, on the cable. 50% is around 134.40, and that's exactly where we find the 200 DMA. So that is going to be the level that you look at. And I know Bran is a pure cable trader. Bran, this is the level, mate. 134.40 above or below, hold above, hold below, is going to tell us likely what's going to happen to the cable for the rest of the day. And I would argue that let those US data tell us what to do with it, because everything that happens now is we're seeing a bit of recovery in the sterling, but it's based on the UK data. It's not, or just based on the fact that the market is maybe a bit short sterling, and wanting to get out of the positions. I would really wait for the US data to tell us where to go. 134.80, 82 is exactly where we went up this morning. But still, to break the pattern that we saw here, we need to get back above 135.10 for a starter, ideally above 135.25.40. And then I think cable can continue to rally. If we actually drop below 134.40 and hold below, there's a risk for 133.60, 133, what is that here? 133.40-ish. And then we have the longer term wedge trend line coming in at around today 133.10, 15. But that would be like really if the dollar pushes on. But that's going to be a big decision zone, because we see lows here, lows there a little bit higher. So this is really going to be a big zone if we get down there in the cable. And just to show you what's been happening again on euro sterling, 87.5, 87.5, 87.5, 87.48, 87.47, 87.5, and again 87.5 to this morning. And we are banging our head against it once more on the euro sterling. So I've tried it a couple of times to see if it would break. It doesn't. I'm out. I will only trade if it really breaks. But I can imagine that on the back of this yet again failure to move higher above this level, we may see a little bit of a retracement deeper down to maybe 87 figure 15 to 88. No, 87. I was right. 87 figure 15 to maybe close the debates on the day, because I don't see where the impulse is going to come from, unless such a really bad risk event is happening for these two to trade above it right here and now. I'm just looking at some of your comments there. Okay, I saw you, Ali. All right. Aussie, Kiwi. Um, Aussie, it's been the same as in most of the dollar pairs, but we know that Aussie has been an outperformer on the cross side of things. We are seeing Euro Aussie lower. We are seeing especially Aussie Kiwi higher. But Aussie is doing really well. Yesterday we had also the sterling Aussie that some of our members were showing that was really on very low levels as well, and threatening to break even further down. So this one is still one that I reckon that could actually break the pattern a little bit earlier if we get negative dollar news, if, always if, we have to wait for the data to tell us. And that's going to happen if that would happen around 70, 75, 70, 80. If we break above 70, 75, 80, Aussie should continue to do well, especially on the crosses, but maybe even on the dollar if that's emanating from some dollar weakness. In the meantime, we have tested during the middle of the night there's been an hour of weakness in the Aussie, which is actually came not on the back of the Australian PMIs, but something else. And I don't know if anyone can tell me what really happened in the Asian time zone here for that drop. But anyway, it tested even really quickly, dipped under the 50% of the move that we had since the start of February and bounced. And where we are, well, we are back around 70 and a half. And that is really going to be, it's really the magnet that we trade around for now. So I would again trade 70-20. The channel is telling us 70.0510. That's probably the max that we could allow for the Aussie to weaken. If it goes down there, it would look a bit bad, because that would also mean that we break early February levels here. Okay, but yeah, this is what I'm still. If the dollar turns around, probably a little bit more positive than others. No, Dimi, it wasn't the PMI. It came out the PMI came out way earlier, right? I think on the Aussie. Anyway, dollar yen. It's an interesting one. Yesterday I highlighted this one, 55, 60, 70. That's exactly where we went to, and now we're coming back off the level again. I Yen crosses are finding a bit of resistance, although they have printed slightly higher levels. We did go up to 183 in the euro yen. We did go up to 10, closer to 110 in the Aussie yen, but we are still seeing the same kind of pattern. Is that we're making a fresh high and then coming back a little bit, because I think that is really the impact of the crosses, and also the market may be thinking that, okay, if we push this much higher, we are running into, whether it be verbal or rate check intervention risk. Okay, and I think that's really what's happening in those in the yen for now, is that yes, you see this higher. I think as well that with a reason we are up here, because if Takaichi says no need to be for fiscal restraint, that, as I have already explained many times, it is normal that the yen, in my opinion, weakens a little bit, or at least gives back what it took over here. But I think the market is a little bit worried that we are running into rate checks also. And being a Friday afternoon, having a massive amount of data, if the data come out better, why not, have a little call out to the friends to see where dollar yen rates are. And then, oh yeah, I wanted to show you the Aussie Kiwi, because we are on a very important level here. And I've been watching this for basically since it was trading 112, 113. I've been talking about that. This is the 118.95, 50% of the whole move from 2011 down to 2020. Okay, I think it's an important level enough. We have been basically nearly in a year of an uptrend in the Aussie Kiwi. It took 12%. Maybe, just maybe, it's time to start to reflect on maybe building in a pause. Okay, I'm not saying it's going to stop, because the fundamentals are still there. I think the Aussie is still a better currency somewhere than the Kiwi right now. It's also pretty responsive if we would have some positive news as well on the Aussie, so we could really test it, maybe even go up slightly above, but it may also be time for a pause. Okay, and a pause may also be warranted, because RBNZ, and we heard from Bremen, and we heard from somebody else as well overnight. Um, a pulse could also be in the cards because they really are not as dovish anymore than they might have been until this latest RBNZ meeting. And from here, data will tell. Now, if we get a break, there's a big level that I also identified above, and that goes back to 2007 over 2010. This is the high here as well in June 2013, and that's the 121. If we ever get up there, maybe it will start to look a bit stretched, okay? But just know, and I wanted to show this, that we are getting really close, inches away on the longer term chart from this 118.95, which in my opinion is a quite important level. Yeah, dollar cat. I know Ryan always shows dollar cat. Always shows dollar cat. It's banging its head against every attempt above 137 has been rejected for now. Okay, maybe this one is working. Nah, it's not working. Anyway, if we'd leave it in, I guess this comes out. Yeah, 137 figure 10. It really has to break above to go and have a revisit of 137.90. That's what I'm thinking about Canada. I still think that Canada could come under a bit of pressure because we heard from Trump and the Trump administration that they are thinking of doing a North American pact without Canada, which basically comes down to having bilateral agreements between US and Mexico and US and Canada, but probably there's going to be more pressure on Canada. That may have an impact on the Canadian dollar. But for the time being, it's not really pushing higher. This is really, if you look at the magnitude of this and you look at the magnitude of something like euro dollar, for instance, it's virtually the same magnitude. So if you look at a cross, let me see, euro cat 161, the figure, it's been there or thereabout for quite a while. It's actually coming down a little bit. So if you look at for a barometer of Canada's strength and weakness, obviously Canada makes it still lower, but we know why. Okay, been explaining that more often than not. But even if you look at it, EuroCAD is even a bit lower. That may be the impact of a bit higher oil or higher commodities as well. But it doesn't show that Canadian dollar is under more pressure than other currencies versus the dollar right now. Okay, that pressure may come back if the U.S. administration starts to get naughty towards Canada again. Swiss is really Euro Swiss is not moving, Adi. Um, I don't have an opinion on dollar Swiss right now. Just for the sake that it's just moving with the euro dollar right now. Yeah, we have a bit of a resistance here around 77.70. Where is it? Yeah, we are really there. But it's not miles away from that 40-45 level in euro dollar. So I really think they are going to move together. So if you know what euro dollar is going to do, I'll tell you what dollar Swiss is going to do. I really don't have too much of a view on this one right now. Gold, silver, both moving higher. I don't think most of this is pre-weekend in case something goes really bad. I think this is really pre-weekend buying some insurance against something bad happening. But we're seeing in the meantime that we are not breaking the big levels, whether it is that 48, 45, 60 or 51 figure 20, that is still intact. I would say for the Friday to continue, monitor what's going on around 50, and 49 and a half. But as I said yesterday, I wouldn't be surprised if both of or if the metals as a bit of a hedge tick up before the weekend, and then we will see after the weekend what happens with it. But yeah, coming out of the weekend, I think this 50 and a half, 49 and a half is already going to be a good enough range to tell us what is going to happen. And silver has gone a little bit faster, had a quite a decent rally here. But the big levels also remain unchanged. Excuse me. We had this dip under 74, but that's been bought up again. So I still think 74, stretch it to 72.5 maybe, is going to be the support. Now we're coming into interesting zones here as a resistance, 81.5, then 83 3/4. But the big one, similar to gold, the big decision inside the really all-time whatever stuff, is going to be 86. If we get out of the weekend and this thing flies over 86, then it's probably going to retest higher levels right now. Okay, guys, and I think I have covered whatever I wanted to cover today, and I will see you on Face to prepare for the US data, and I will have guests around for Face as well to help me out. So make sure to come and visit on Face in about 1 3/4 hour. See you then. Thank you.